Good afternoon, everyone. I see we're just getting a couple of the last people on video, but we'll get started in just a second. This panel is 2021 Regulatory Outlook, and we have a great group. I am Nihal Patel. I'm a special counsel in the New York office. I primarily do regulatory work related to derivatives and securities. I'm going to quickly introduce the panel and then mostly try and stay out of the way of everyone else because we have four very smart people and a very short period of time. So we have Scott Cameron, who is a partner in our New Charlotte office, who does everything banking. Stephen Lofgy is in New York, is an expert in securities and derivatives regulation. Mark Howe is a senior partner in our tax department. And Rachel Rodden is in our litigation department, but has a great expertise in consumer protection based on experience at the CFPB. Jumping in, so obviously there's been a lot of political change in the last week or two. So I want to start with Scott. And Scott, if you can tell us a little bit about what you expect to see at the banking agencies as a result of expected change in administration.
Yeah, so the Biden administration was pretty close to the vest in terms of legislative plans for banking changes. As part of the Biden planks, they really only mentioned a handful of items that they were planning to do legislatively, and most of those were in the consumer areas, such as fair lending reform and non-discrimination and access to banking. They did that on purpose, obviously, to avoid alienating Wall Street, but we have seen some signs that the Biden administration is going to fairly swiftly make changes to the agencies. Last week, it was announced that Gary Gensler was going to be part of the transition team to help review the agencies. And as we all know, Gary Gensler was a fairly aggressive regulator at the CFTC. That suggests that Biden's going to move fairly quickly and pick agency heads that are much more aligned with the Democratic view. And I think he can do that fairly quickly. Frankly, the OCC is headed by Brian Brooks. Brian's an acting comptroller, which means that he can be replaced effective immediately. At the CFPB, which Rachel's going to talk about later, Kraninger can be replaced instantly based on the Supreme Court's recent decision. The FDIC has a board of only 4 people. There's currently a vacancy. 2 of those spots are allocated, one to the OCC and one to the CFPB. So Biden can, with the selection of an OCC head and the CFPB head and a new selection, he can get Democratic control of the FDIC, even though the chair, Yellen McWilliams, is a Republican. The last agency is going to be a little bit more complex. That's the Fed. There are currently only 5 governors at the Fed. Biden can appoint 2 new governors. The other governors have 14-year terms, although their roles inside the Board of Governors, changes. The chair of the Fed, his position expires as chair in 2022. So there's little that Biden can do to replace the chair of the Fed, but the very important position of vice chair of supervision, which is currently headed by Randy Quarles, that position expires in October of 2021. In other words, a little less from a year from now. It's pretty clear that Biden will probably move fairly quickly to replace that position, because Quarles has taken a stance that I think is not very popular with the Democrats. So by this time next year, it's pretty clear that if Biden chooses to move quickly, he can have control of all the agencies, which means that the agency views will then become espoused. We'll see a much more aggressive financial services agencies in terms of their responses to the banking industry. In particular, the Democrats believe that the Trump administration was a little bit too lenient on the large banks, so we could see some cracking down on the large banks, tightening of capital rules, because Basel IV is coming out in the next 2 or 3 years. So all in all, by this time next year, I think we're going to see a new composition of the agencies, a new tone at the agencies, much less willing to be lenient toward the larger banks, much more sensitive to consumer issues at this time next year. So let me pause there. I think we could get back to legislation Nihal, I'll turn it back to you and the others on the panel about what changes that they see in their respective agencies.
Sure. I guess next I wanted to move to Rachel, just to follow on from what you had talked about on the CFPB and about the change in leadership, and obviously that entity. Scott, you and I wrote a memo about that change, and the leadership of that agency has been in the news quite a bit.
Thanks, Nihal, and hello, everyone. So I wanted to pick up on something that Scott mentioned about the Consumer Financial Protection Bureau. There was a Supreme Court decision earlier this summer that resolved an issue that's really been simmering in the appellate courts for a while. And the question is, does the president have basically unfettered discretion to remove the CFPB director? When Dodd-Frank was originally passed, that power to remove a director was limited. Basically, the president had to have a reason to remove the director, and that was justified as a, I'm sorry, my phone is ringing. That was justified as a way to protect the agency's independence. In a recent Supreme Court opinion, the Supreme Court said that was not appropriate, that was not consistent with the separation of powers doctrine. And so the president now can remove the CFPB director on day one. Now, the CFPB director is still a Senate confirmed position. And so the composition of the Senate, we think, will influence what the agency, who the president is ultimately able to put into that position. But in the interim, the president does have the ability to fill vacancies through the Federal Vacancies Act. And that would allow him to choose someone who was already either Senate confirmed or is a high ranking official. And there are two names that are being floated around right now who could have that sort of immediate ability to step in. One is Rohit Chopra, who's currently a commissioner over at the FTC and previously worked at the CFPB in the student lending space. And the second is Patrice Ficklin, who's been a longtime senior official at the Bureau running fair lending. And I think either of those officials would be top choices. And they really represent, and we'll talk about this a little bit later on, a continuation of the Obama-Biden policies that we saw in 2008.
Great. So similar question going now to Steve, focusing on the CFTC and SEC. Both, what kinds of changes do you expect, and is there anything we can look to what's going on at those agencies currently that might give us clues about what could happen in the future?
Sure. So in a lot of ways, I think I'm going to say my answer is similar to Scott's on the banking side, in the sense that there is not much that has been proposed by the Biden camp as far as legislation goes on the securities or the commodities side. The only real legislation that came up, other than I'm going to say Elizabeth Warren sponsored legislation, was to do with some expansion of insider trading regulations, which I think is a meaningful but somewhat fringe issue as far as the kind of the larger political issues are concerned. So the big changes are at the agencies. The SEC and the CFTC are both 5-person commissions, split 3-2, with the 3 being the president's party. The chair of each of the agencies really controls the agency, in the sense that everyone at the agencies reports to the chair, except that each of the commissioners has relatively small staffs. I think it's 5 people at the SEC that they can use to help them respond to proposals. But as far as what proposals are going to come up for rulemaking, that's really all at the discretion of the chair. So I would expect that what would happen is that the chairs at each of SEC and CFTC who are Republicans would resign, that there would be acting Democrat chairs likely named, and that the process would then start for naming a 5th commissioner at each agency. My guess is that the majority or maybe all of the other commissioners at each of the agencies may stay on. Certainly at the SEC, I do expect that both of the Republican commissioners, actually I expect at the SEC, all 4 of the commissioners, other than the chair, will stay on. So that makes it, very much of a wild card as to what happens depending upon who the chairs are. And there was very much of a split during the Obama years, meaning at the CFTC, you had Chair Gensler, I'm not sure exactly the words that Scott used, but fairly aggressive in his rulemaking, pushed through a lot of rules quite quickly, was very adverse to granting no action relief on the rules. And at the SEC, by contrast, you had 2 fairly long-time industry participants, Mary Shapiro and Mary Jo White, and there was much less of a dramatic change of course at the SEC during the Biden administration than there had been, during the Obama administration than there had been at the CFTC. So with Gary Gensler, who had been at the CFTC, being named as one of the leaders of the transition at the financial services, if there is I'll say a Gensler lookalike at the SEC, you could get a very, very different SEC under the Biden administration that there had been under the Obama administration. So a lot's going to depend on the chairs.
Right.
Nehal,
So
there's
just-
a saying in Washington that personnel is policy. And it's like we're talking about people and it sounds like a bunch of musical chairs to folks perhaps, but that's really the takeaway here, which is, and we're going to talk about legislation in a minute, but control of the administrative agencies is a key way that a Democratic president can influence policy in these areas going forward. And so we expect Biden to do that and to put in folks who, share his viewpoints on the role of the administrative agencies and how they should proceed in regulating these markets. And he'll do that through his picks for the various agencies.
Yeah, with I'm going to say one question being, we don't really know what his views are in a lot of ways. We know that there are splits within the Democratic Party as to, I'll say, the Wall Street, more centrist view, which was a supporter of the Biden ticket, and I'll say the Sanders wing of the party, which would be, much more aggressive on a fair number of issues. And which of those 2 wings is influential or more influential in determining the chairs could have a huge effect on regulation for the next several years.
The other thing we need to keep in mind, and we'll talk about this in a second, is even if those 2 Senate seats in Georgia are taken by the Democrats, and with Vice President Harris being the tiebreaker on any legislation, it seems very unlikely that the Biden administration, with the mere majority of 1 single vote in the Senate, is going to push through any controversial financial services legislation. It's too difficult to do. It's not a priority of the Biden administration, at least based on the whole the elections process. So more likely than not, the changes we're going to see over the next 4 years will be coming out of these agency heads and the composition of the agencies. It's much easier to drive change through the agencies than through legislation. The one exception, of course, being tax, which I think Mark is going to talk about in a bit.
Yeah, so actually, that's a great opportunity to pass it to Mark. Let's see, I'll let you finish.
So on tax, I would take a little bit different tack. No pun intended. It is less inside baseball, less regulatory driven in the tax area. It really is a legislative game. And if you were to, and really primarily where President-elect Biden is on taxes and how he interacts with the Senate. It really, those are going to be the two main drivers of tax policy. And you can sum up upcoming tax policy as undoing the Trump tax cuts plus some. That's really the essence of the Biden plan. So whatever his tax team is, that's going to be less influential than the interaction between the administration, the president, and primarily the Senate. We'll get into that in a moment. So that's the big picture.
And Steve, Scott, Rachel, unless you had anything further on the admin stuff, Mark, I actually did want to pass it to you on the legislative aspects and where you see the tax law going. Both, whether or not the Senate goes one direction or another, what are the likelihood of any significant changes to the tax law?
So President-elect Biden, and I'm going to use the cultural meme 28-3. People from New England and Atlanta know what that means. So it's not over till it's over. And that's particularly true for the Senate. We really don't know where the Senate's going to end up. And the assumption at the start of this forum was that we would have divided government. That's calmed the markets. That's not at all clear where we're going to end up. And that is going to be a big piece of where tax goes. And that actually will implicate some inside baseball, which we may or may not get into in a moment. But big picture, there is a Biden tax plan. It's substantial, calls for about 2.5 trillion in tax increases over the next 10 years. There are debates of whether it's a higher number or a lower number, but it's a fair number. About 2/3 of that burden will fall on businesses. About 1/3 will fall on individuals. There is a 1-year delay in light of COVID and the economy. So if this were all to pass, it wouldn't be effective until January 2022. And it should be noted that none of these tax increases are earmarked for deficit reduction or debt reduction. The Biden spending proposals are far in excess of the $2.5 trillion that is in his plan. So that's the big picture. The headlines on the Biden tax plan really fall in the individual space. And they're really, well, the basic structure is the 99.1% breakdown that we've heard in the popular culture. Fundamentally, the Biden plan says that for 99% of the taxpayers, no tax increase. And indeed, for the bottom half of that 99, we're going to try to get you some relief from federal tax by expanding various credits. But for the 1%ers, that's a different story. And in the Biden plan, they define the 1%ers as households with incomes of $400,000 or more. There is where the first headline comes, which is a substantial increase in the marginal rate. Right now, for a household that's making $400,000, they pay about 32% at the highest marginal rate. Under the Biden plan, it goes up to 52%. So that's over a 50% increase in the marginal rate for households above 400,000. And the primary driver there is the introduction of the payroll tax at levels of 400,000 or more. The payroll tax is currently at 12.4%. The Biden proposal would reimpose or impose a payroll tax for incomes above 400,000. And so that would create a big jump in the federal tax bill of those households. The other piece to it, which is really smaller, is an increase in the marginal rate from 37 to 39.6. But the headline is a major tax increase for the 1%ers. The second headline under the Biden plan is effectively doubling the capital gains rate. Currently, as most of you probably know, it's at 20%. Under the Biden plan, capital gains for households with incomes over $1 million would be paying tax at the 39.6, which would be the highest marginal rate. So it's effectively a doubling of the capital gains rates. Those are the two headlines. Even though individual tax increases are only 1/3 of the whole of the proposal, the big headlines are substantial increases for households in the 1% group and a doubling of capital gains for the wealthier individuals.
That's great. Actually, just as a now for the audience in particular, if I'm in the financing world, what is my high ticket item out of the Biden plan? Like what am I most concerned about, do you think?
Well, on a personal basis, if you're in the finance world and you live in New York or California, you're looking at an overall tax burden of between 58 and 65%, depending on what they do with SALT. And in the Biden proposal, reinstatement of the deduction for state and local is part of it, which is not progressive, it's regressive. The really for financial institutions, if we move to the business side, they're not particularly targeted. If we do the business tax, there are basically three big points. The first is raising the rate from 21 to 28%. The real number is probably 25. At 25, the US remains competitive with other industrialized economies in terms of taxes. The next thing is a minimum tax that's basically aimed at companies that are highly profitable, but seem not to be paying a lot of federal income tax. And that the major piece of that proposal is to impose the tax on book income, which is viewed as a better measure of income than taxable income. The third point is for small businesses under the Trump regime. One of the themes of the Trump regime was to equalize how tax worked, whether you were a corporation or a pass-through. And the way that they did equalize it was through a 20% deduction for small businesses that were done in a pass-through structure. That is going to be limited fundamentally based on the 99-1 break in the Biden plan, so that only families with incomes under $400,000 will get that benefit. So those are the three major highlights, which is increasing the rate, trying to impose a minimum tax on highly profitable companies, and raising taxes on small businesses. But there is a financial risk fee in the Biden plan, but would only apply to 20 of the largest banks in the country.
So thanks very much, Mark. I want to actually move one more legislative point, as Steve and Scott had indicated, less action at least expected right now on their front. Rachel had a few things she had mentioned to me that could be interesting from a Congress standpoint. And then after that, actually, just to preview, I want to respond to a question from the audience primarily. I think is going to start with Steve, maybe Scott also.
So I agree, Mark, that so much of what's going to happen will depend on the question of the Senate, and we'll have to see how that turns out. It's certainly getting a lot of attention from both sides. I think that there are three items on the wish list of Democrats in the consumer financial protection space. So the first is establishing a public credit reporting agency. There's a lot of dissatisfaction in Democratic circles with the existing regime, too many errors and things like that. And so that's an item that's high on the list. Another issue that would require legislation would be establishing banking services through an entity like the post office that would be designed to serve underbanked and underserved communities. And the third item, just to throw something in, I don't know if you all recall, I think it was 2017, the CFPB issued a rulemaking that effectively barred the use of compelled arbitration clauses in contracts for consumer financial services. And that rulemaking was rescinded under the Congressional Review Act. Now, this would take probably more than 50-50 Senate with Vice President-elect Harris as the tiebreaker, but Congress does have the ability to allow the CFPB to reissue that rulemaking or something similar. And it is an area that remains one of great concern amongst the consumer financial protection advocates.
Great. Look, I agree with that. And I think that the shape of the Senate probably on the CRA front could be an interesting further outcome on that.
Yeah.
So I'm going to start with Steve on a question we got from the audience, which is on fintech. The question was, what do we expect to see on the innovation programs that, in particular, the OCC and the CFTC has set up? And I think I'm going to read that question a little more broadly, like in the fintech space, do you have any sense of the Biden administration making any changes to current trajectory?
First, let me check that I am off mute.
You are off mute.
Okay. So I'm not sure the CFTC, frankly, is that significant in the fintech space, in the sense that what they regulate is derivatives on crypto, which is kind of a second order, issue. So, the real issue on the securities side is about some kind of initial coin offerings and cryptocurrencies and whether they are securities. The most aggressive person there in terms of pushing for regulatory change has been Commissioner Peirce, who's a Republican. I don't know if I see energy on the Democratic side to facilitate crypto products. Kind of facilitating them means allowing investors to go into products that are inherently riskier and speculative. And I think in general, the Democrat attitude has been more paternalistic and protective. So I don't think the CFTC is really so significant in what they do, and I see allowing more crypto products as being contra to the, I think, more paternalistic attitude of the Democrats, focused more on investor protection and keeping investors out of riskier products. So that's where I think it will go. On the banking side, I would defer to Scott.
So on the banking side, that's a really good question, because in the banking side, the theory behind fintech is that it provides efficient banking services to persons who otherwise don't have access to banking, the unbanked and the underbanked. And therefore, you would think it would be a good thing, because the Democrats believe that providing services to the underbanked and the unbanked is an important responsibility of the financial services industry. The challenge is that the Democrats also believe that the way in which the fintech model has been rolled out is too aggressive, in the sense that it overrides protections that are normally afforded to consumers. In particular, the marketplace lending model that allows loans to be originated through a bank and then sold back to the fintech lender and then distributed out into the industry in the secondary market. Because of the way it's originated, there has been lots of litigation and argument as to whether or not these type of programs are entitled to exportation of rates or preemption of state usury rates. This is an issue that I think is going to be fought out over the next few years. It seems likely that the Democrats are going to push back on this model and say, look, we support providing these type of services to the underbanked through financial means, but we do not support the way in which it's rolled out that results in preemption of state protections. So I think you're going to see kind of a retrenching of the marketplace lending model, with more sensitivity towards preserving state protections, including usury protections, in the model. I mean, let's keep in mind that 8 states or 9 states are currently suing the FDIC and the OCC over some of the recent rules that they've adopted that promote this model. So I think that there will be a continued effort to keep some type of fintech model, but it's going to be tweaked so that it is much more likely to be not override state protections afforded to consumers? Great question.
Yeah, actually, if I can pick up on something Scott said, obviously the focus of our discussion has been the federal government, but in fact, the states have been much more aggressive over the last 4 years in going their own way and challenging federal decisions. And we're sort of seeing, I'll say, a Brexitization in some ways of the US federal financial system. And really uncertain whether there's a halt to that because there's a Democrat administration, or whether we see more of the states going their own way and imposing their own restrictions that are more severe than federal restrictions.
I'd like to follow up on Steve's point that's also true. That's a theme in the tax area where states are pursuing policies that may be a little bit ahead of where the federal government is. One where we see it in New York is a proposal to mark to market the assets of wealthy households, meaning that assets that have appreciated are treated like wages and taxed each and every year. So that is something that is left out of the Biden program. It is in the Democratic House, Democratic Senate proposals, but the states are taking a lead. It's also true with carried interest, in the sense that the states have been more aggressive in taxing carried interest. Now, the Biden proposal does put an effective end to carried interest for the PE industry and the real estate industry by basically doubling the capital gains rate. But Steve's right. You do see states, not so much in response to the Trump administration, but in search of revenue and addressing wealth discrepancies.
So, Nihal, I'd like to hear Rachel's view on fintech, because frankly, given the role of the CFPB and its responsibility given to it by Congress to prevent abusive practices, you would think that the whole fintech issue would be something that would land squarely in the lap of the CFPB. So, a lot depends on who gets the reins of the CFPB, but I'd be very curious as to Rachel's view. How do you see changes in fintech in light of a new CFPB?
I was about to jump in to provide my 2 cents on the fintech question. So I think if there's a couple spaces where the CFPB will be forward leaning, and in my view, unquestionably fintech will be one of them, if only because regulators like nothing more than to stay relevant. And fintech is a place where you absolutely, I think, have to be relevant in today's day and age. There are 2 particular proposals on the table that will position the CFPB to be a major broker, I think, in this space. The first is a proposed rulemaking under Section 1033 of the Dodd-Frank Act, which provides the CFPB express rulemaking authority around the basically consumers' access to their own financial information. So right now, there are a lot of fintech companies that are fundamentally based on consumers providing those companies access to consumers' financial information that is maintained by brick and mortar financial institutions. And consumers allow the fintechs to have access to that data. The fintechs scrape that data, and then they use it for a myriad of things like, advisory work, helping with your credit, helping manage your debt, etc. So the Bureau just recently put out a advance notice of proposed rulemaking on that question, and it will be hugely impactful for that industry, how the Bureau, weighs the competing interests there. The second issue is one that's a little bit of a sleeper. So right before Cordray, former CFPB Director Richard Cordray left the Bureau, they had put out in their unified regulatory agenda that they intended to look at issuing a rule that would bring installment lenders, so personal lenders, under the CFPB's supervisory authority. So the CFPB has the ability through rulemaking to bring non-banks under its supervisory jurisdiction. And there's not a ton of detail on this, but I expect it would include fintechs that provide personal loans, which is many of them. And that act of, bringing those kinds of companies under supervisory jurisdiction, which means they're examined, their compliance management systems are reviewed and held to the standards. Scott, I think, is smiling a little bit, held to the standards of traditional financial institutions. That will be a way that the Bureau will really have an impact on consumer protection in that space. And if they do it, I would think there would be a lot of both supervisory and potentially enforcement activity that could flow from that single rulemaking. Nihal, you're on mute.
Truck went by, so I went on mute. But now that it's soft, so that actually leads to to the next question I want to ask, and we're down to about 10 minutes. But I would guess the last proposal you just talked about was fairly controversial in a number of circles. So one thing, as we're looking at potential actions in this administration, and I'm going to start with Scott, but then I had a question specifically for Steve after that, which is, what kinds of things do you think are on the wish lists of either participants in the market and or activists, non-market participant activists, that are just kind of unrealistic, or to the other side, that are potentially a big deal but are more realistic and could you see get passed? The question that I heard on one of the earlier panels today is some people worrying about what's the status of Volcker changes that were passed in the last year or two, and is there any risk that those get taken back?
So my personal view on Volcker is this falls into the bucket of not likely to happen. This would consume so much of the agency's time because 5 agencies need to be involved with any type of Volcker rulemaking. It is much easier for the agencies to adjust their Volcker view through the enforcement mechanism and the supervisory mechanism rather than attempting to undo the rules that were issued. So while I think you've heard some people say that Volcker, we're going to tighten up Volcker, there'll be new Volcker rules, I think that's unrealistic. Too much capital would be required in order to do that, political capital. What is more likely is, an adjustment of the enforcement attitude of the agencies. For example, guidance on guidance, which is the idea that agencies shouldn't take enforcement action based on unwritten concepts. They only can take enforcement actions based on rules. That probably may get backed off on. The Democrats like the flexibility of the agencies. If they see something, say something. If they see something they don't like, they should be able to bring in enforcement action, even if it doesn't require a rule. So I think you'll see a backing off on guidance on guidance. I think Volcker will stay in place. Where you will see, I'm fairly confident, is student loan reform. You're going to see CRA reform, including possibility of backing out some of the CRA changes that were made by the OCC. And you're going to see more focus on fair lending and protected class status in consumer lending issues. Those are the areas that I think are much more likely to happen.
I just want to second that from what Scott said around fair lending. I think it will absolutely be a huge focus of the CFPB. It is not an area where current Director Kraninger's CFPB has focused. And given that one of Biden's sort of key pillars of his agenda is racial equality and wealth accumulation, I think fair lending is going to get a lot of focus from the Bureau.
I want to move to a topic that Steve has written, two topics that Steve has written about quite a bit recently. And one is climate change related matters, and particularly the CFTC recently, an advisory committee of the CFTC put out a report on this topic with a number of regulatory suggestions. And the second And again, sort of thematically, things that are seen as more political, social issues that are coming into financial regulation is, to what extent do you see ESG type regulatory changes coming in the way that they've happened say, in Europe?
Well, I'm going to semi-ignore your question, Nahal, in the sense that, look, my main comment on the CFTC was they just don't really have any authority in the area. So I think their putting out a statement on it was, as Rachel said, being in a relevant area. But the regulators that really have authority with ESG topics are the SEC and the banking regulators. So I know we just have a few minutes left. What I'm going to do is kind of read off a few areas where the Democrats have dissented, either at the SEC or the CFTC, and that could be an indicator as to where they're going. They've dissented from every loosening of corporate disclosure and have pushed for more ESG disclosure, dissented from a loosening of private placement standards. They have dissented from a tightening of the restrictions for shareholders submitted proxies. They have occasionally dissented from granting waivers of collateral consequences and enforcement actions. I'd say those are some of the big dissents at the SEC. At the CFTC, dissents around imposition of position limits. They'd like those to be tougher. From the regulation of algorithmic traders and from the level of capital requirements as to swap dealers. So I think in terms of where the Democrats have dissented, I would see those as being pretty significant areas. Another thing I might throw out is just on the disclosure front is disclosure about corporate contributions, political contributions, though maybe less of a focus given that most of the money really went to the Democratic side. That may be of less political interest, but we'll have to see.
So Nihal, on ESG, I think it's fairly likely we're going to see something like this. There's already a model in Europe to roll out ESG type regulation. This is something that the Biden administration could charge the agencies to do. It becomes a stop to the progressive wing of the Democratic Party who wants the Green New Deal. You could see an ESG being something, a way in which the Biden administration appeases the concerns about the progressive wing of the Democratic Party by saying, look, we're rolling out rules that address these issues in terms of disclosure. So yeah, I think ESG is something that very likely could happen in the next 4 years.
Great. So we have 2 minutes left, and I want to actually go back to Mark because Mark, I want to just ask a more broad question of if you're in this space in financial institutions or at borrowers, where in the tax law are you most focused for the next year? Where are the issues you think are most likely to come up?
If nothing happens legislatively, then there may be more enforcement, and there has been a discussion in the public press about, and this may in part be a reaction to the Trump tax returns, more enforcement on tax shelters. But fundamentally, I think the big thing is going to be more progressive tax system, and that is going to affect, really will play itself out in the individual space than, for example, distinguishing a financial institution from an operating company. And in fact, there is focus in the tax plan for Biden to encourage manufacturing. And as I said, it looks as though carried interest might be dead.
Wow, I feel like I've heard that for the last 20 years, but that's interesting. If anyone has any final thoughts, please feel free to jump in. But I think as we hit the time, I'll say thank you to the participants and as well as to the audience.